Well, taking a look at the markets, we've got on the one hand valuations looking cheap and more offshore than anything else. But important to bear in mind is that on the other hand, it's within a context that's very uncomfortable, very uncertain at this stage. So what's your reading of the markets picture at this stage?
Look, I think the market's in a situation where it's looking at economic numbers very carefully, like the non-farm payroll we're going to get this afternoon. And the reason is because, as you say, valuations are okay, but they're okay because profits are so elevated. If you look at profits as a percentage of GDP across the world stock markets, so if a listed company profits to GDP, it's at an all-time record. Okay, now you wouldn't think so given the turmoil we've had in global economies in the last however many years. But that's true. So companies did a very good job of cutting the fat in the downturn in 2008, 2009. So as the economies recovered, their profits have come roaring back. And so that's a challenge. You know, you look at a PE multiple and it's low, but it's low for two reasons. Either the price is low or the earnings are high. And unfortunately at the moment, the earnings are high, which means that if there's any risk to earnings, like a slowdown in global growth, earnings get smashed, and so equities no longer look that cheap. And that's why people are so focused on economic numbers to give them a read as to where corporate profitability might be heading.
Of course, that event risk today, as you highlighted, coming through in the form of non-farm payrolls numbers, keen eye being kept out for that. Is there just too much hype around jobs data like this? Because I was chatting to Kim Voyezes of Trident Capital a little earlier this morning, and he says he just thinks that there's too much focus on singular data points at this stage of the game.
Maybe, but I think the market's justified in looking at these data points. And the reason is because I don't think any investor has a very clear picture of where global growth is going. And they know that the Fed is kind of out of bullets with QE2 and, you know, so if you've got almost zero interest rates and you're printing money, what do you do if that hasn't ignited economic growth? And that's why I think there's so much focus on economic numbers at the moment to see whether what they have done previously with stimulus is actually feeding itself into growth. If it is, fine, then it's worked and, you know, we can justify higher equity markets. If it hasn't worked, then you get into this potential vicious circle where no growth, no bullets left to stimulate, equities look expensive, big sell-off.
And that's why there's also so much of a focus on Asia and that economy specifically, whether China is going to step up and take the place of a consumer like the US.
Yeah, well, I think the problem is it's done that for so long now. It's almost, China is, you know, it's got to slow a little bit at some point. Is the rest of the world going to be able to pick up the slack that China loses when it slows a little bit?
What's interesting is, you know, when you're looking at the BRICS nations specifically and their growth stories, we had just this week Brazil cutting its interest rate back, and the first of those BRIC nations to do so. Many asking the question whether China at least maybe not cut rates, but put a hold and hold steady on their rates moving forward.
Yes, exactly.
Your view?
Well, look, I actually think that it's even more pertinent in this country. So, you know, 2 months ago, the FRA curve, you know, the sort of bond curve, was pricing in a rate hike. Everyone was worried about global inflation and gold prices going through the roof because of it. Now, the bond market's pricing in a rate cut. And you can see it in the equity market. The retailers have had a huge run. I mean, I think Woolworths is up 20% this month. Same for Foschini Group. There's some really, really strong moves in the South African retail stocks because the investors, particularly the offshore investors, move from, is South Africa going to raise rates, to could they potentially cut rates, and what are the sectors in the stock market that are most exposed to that? And that's what's driven to some extent the banks, but predominantly the retail stocks in the last month.
What's your view on the viability of a rate cut being introduced in South Africa right now? Because we've been hearing the question, what's a 50 basis point cut really going to do? How are monetary tools going to do the job within a deteriorating global situation?
Yeah. Look, I think that's the right questions to be asking is, will it even have an impact? Personally, I think it would be a mistake to cut rates. I think South Africa has some unique inflation issues, wage, power, stuff you've talked probably a lot about on this show. And so, you know, I think the way we were trying to be last to raise rates, I think we should also be last to cut rates if the reason for cutting rates is driven by a slowdown in global growth.
Exactly.
Yeah.
Taking a look at that global slowdown, are we on the brink of a recession or not? Another question being asked is, how is this time different to what it was back in 2008?
Yeah, that's a good question, and I think that's why there's so much panic at times in the market is, if you look at what's happening in the credit market, bank credit spreads have blown out, okay, now, and also the monetary kind of stimulus is similar to 2008, what much more can you do? So investors are concerned that some of the parallels that caused us to have a banking crisis, for example, in 2008, where you could have got early signs of that by reading the tea leaves in the credit market, proved to be true, and so why wouldn't they necessarily prove to be true now?
Yeah.
Now, I think it's very different today versus 2008 with one caveat, which is that Europe is a complete wild card. So I think the US banking system, very different today to 2008. They've got funding sorted out, it's long term, it's not short term, and they've got much more capital on the balance sheet than they had in 2008. Corporates are in better shape today than in 2008. So all that sort of liquidity funding issue that we had in 2008, where everyone woke up one day and said, I want my money back. I've lent you money, I want it back. That stuff is much less prevalent today than it was in 2008, except for the European banks.
Yeah.
It looks like in Europe, all they've really done is they've moved bank debt into sovereign debt. And so you still have a potentially big issue there around sovereign debt in Europe, like you had bank debt in the US in 2008.
So very briefly, how should investors position themselves in the current market?
Yeah, we think there's still enough opportunity that gets created by the volatility to buy quality. So we don't think that what happened in 2009, where the markets recovered and this sort of low quality rally, you know, the beta rally, is what you should have been invested in. We think today, use softness in the market to pick up high quality, so dividend yielding, defensive sectors, a bit of global where it's maybe cheaper than local. That's where you should be investing.